Hi, I'm Martha Beaudry. I'm a realtor with Boulevard Realty. Welcome to my home buyer video series. Hi there. So today I thought we'd talk about financing, and Puccini's with me today. So this is Puccini. He's my little buddy, and you might see his head pop up now and then. So anyway, financing would be a good topic for the day. I'm sure that a lot of you are trying to determine maybe what kind of lender you're going to want to do, what's available to you, how much you should be kind of putting together as a down payment. So maybe some of this information will help you. So let's begin by talking about the types of lenders that are available to you. So there are online lenders. I'm sure you've seen their advertisements. That would be Rocket Mortgage, Quicken Loans, things like that. These guys are pretty good. They can be competitive. They're very aggressive, especially when you're dealing with the frontline person. And then usually the way this works is once the frontline person, you're in contract, you've put an offer on your house and everything, and you're ready to move on to the next step, you're moved on to somebody else within the organization. So whatever the guy promises you on the phone, you need to make sure you get that in writing, because when you get over to the next person, if you start fresh. They're okay. You'll close. Some agents don't like working with them, but for the most part, they're fine. Big banks, Wells Fargo, Chase, Bank of America, those are always an option. Do not assume that if you're already one of their clients that you're going to get some sort of special privilege or be treated differently, because you will not be. It makes no difference to them, and they're okay. They can be competitive, and they can do a good job as well. Mortgage lender, a local mortgage lender, these are the better choices to go with. They're usually available to you not 24/7, but when you need them. They're available in the evenings, they're available on weekends. And if you're going with a lender that a lot of other realtors know of, then it helps you when you submit your offer if you're in a competitive situation. So a lot of times when there are multiple offers, one of the things that agents look at are who the lenders are, and they want to know if the lender is going to create complications for a close for their client. They want it to be a really smooth transaction, and if they don't like the lender, they could actually pass on your offer and go on to one with a stronger lender. And then finally, credit unions. Credit unions are doing really well. They've got great interest rates that are available to you, and they are doing very well in meeting the obligations and timelines of these contracts. I've had several clients use their credit unions, and it's been a great experience for everyone. And their lender was actually able to make himself available on weekends and late in the evenings. That doesn't necessarily mean that'll be the case with your credit union, but they're worth looking into. All right, now let's talk about the types of loans that are available to you. Common one is called a conventional loan. You're basically going to put 5, 10, 15, 20% down. Just know that the nice thing about a conventional loan is that if you put down at least 20%, and what that means is when you put down 20%, the bank has, or your house has 20% equity. And that eliminates or reduces risk for the bank. So if you have at least 20% down, you won't have to pay an additional fee on top of your mortgage known as a private mortgage insurance. It's always nice not to have to pay that. So if you put down less than 20%, you will have to pay private mortgage insurance. But the nice thing is that once your home reaches 20% equity, you can have that dropped. So it's always something you can work towards having removed. It doesn't have to stay on your loan permanently. But just know that by putting down at least 20%, you can eliminate that payment. And then there are government-backed loans. FHA, they require 3.5% down payment. Just know that on that one, you will not ever be able to get rid of private mortgage insurance, even if you have 20% equity. It stays with the loan for the life of the loan. And I think, if I'm not mistaken, some of the closing costs and fees are a little bit higher with FHA loans. And there's some complications, or not, I wouldn't say complications, but just some hurdles that have to be, jump through on those. So if you don't need an FHA loan, I would not get an FHA loan. VA loans offer 100% financing. These are for our veterans. Those are excellent programs. They have some hurdles too, but for the most part, if you are a veteran and you can take advantage of this, it's a nice thing. And then we have rural loans for like farmers and people in small towns that have different types of economic needs. For the most part, these will not apply to you, but they're out there. All right, and then the jumbo loan, and that's if you're going to have a mortgage in excess of $424,000. Those are usually riskier for banks, so they have a tendency to have higher interest rates than conventional loans, but I've been told that as of today, November 2018, they are about the same. You're going to have the same interest rate whether you have a conventional or a jumbo. So those are the types of loans that are available to you. So as far as qualifying, they're going to be looking at your credit score. You want a good credit score. When I say good credit score, above 600. A really good credit score is above 700, and an excellent credit score is 800 or above. And your interest rate is really going to be determined by your credit score. You can pay for a better credit score. They're called points. Might be 1% of your loan if you want to come down, a point in your interest. So you can buy down your interest rate. Just know that your credit score is a big factor in what your interest rate will be. Savings, you'll want to have money saved up for down payment and for closing costs. I will do a video that explains closing costs, but closing costs are basically money you'll need to spend in addition to your down payment when purchasing a house. And so you'll want to have that saved. I would have an additional, if you're looking at, a $300,000 house, I would have an additional 1.5% saved to cover your closing costs. That may not be enough. Maybe 2%. $6,000 should cover it for a $6,000 house. That should be enough for you. Your lender will be able to give you a breakdown of closing costs and let you know what they will be. And I will be doing a presentation on closing costs so you can get an idea how to calculate what you're going to need. Job security is very important. They want to see how long you've been in your job. And so if you've switched jobs recently, it's not such a big deal if you're still in the same industry. So if you were an engineer for Kellogg Brown and Root and then you quit and then went and worked for Bechtel, but you're still an engineer, that's fine, as long as there's consistency and you haven't switched careers. So they wanted to see you have some lines of credit. Student loan, car loan, and a gas card or a bank card would be fine, just as long as you have 3 lines of credit. Don't go off and, build a lot of debt. You don't need to do that. You can have a credit card and then pay it off and just keep the card active. That's considered a line of credit. So it's good to have 3 lines of credit. And then they're looking at your debt to income ratio. Basically, they want to know how much you owe and how much you're making. So you just take your total recurring monthly debt, all of it, and then you divide it by your monthly income. And so conventional loans are looking for 45% debt to income ratio. And as long as you're not above 45%, you should be okay. If you're looking at an FHA or a VA, they'll take 55%. So calculate that, and that'll give you an idea of what kind of hurdles you might have in trying to get qualified for a loan. So here's some final thoughts. If you're an unmarried couple, you guys want to have a serious conversation about how you want to do that. Talk to a CPA. There are tax implications involved. There are homestead issues involved. I personally think that both parties should be on the mortgage and both parties should be on the title if you're going to do this, and that way you're both protected under homestead, and you have tax. You're both protected. You have your tax benefits that come to you. So a CPA will be able to help you better understand the tax implications, and you may want to talk to an attorney about other things, but those are my thoughts. I do think that you should be. Some people may have a different perspective on that. Once you've been approved, do not shop. Do not change your credit. Don't go off and buy an expensive car. Don't make any big unexplainable deposits into your account either. The bank likes everything to just kind of look normal and calm. They don't like surprises, and they will check your credit again before you close. So don't go putting anything on your credit cards and applying for any new credit once you've been approved. Your loan will more than likely be sold. So you'll close at the closing table with ABC Loan Company, and then the next day discover that Chase, Wells Fargo, or BBVA of A has purchased your note. So as soon as you can lock in your interest rate, you want to do that. I know that they're anticipating in December of this year, 2018, for interest rates to go up again. So if you're looking at wanting to do something here in November, apply, lock in your rate. I think you have 60 days to close. So that gives you some time to do what you need to do. So you want to lock that in. And that's it. I hope you found this video useful. If you have any questions, you feel free to email me at my email address below. I'd be more than happy to answer them. I'm never too busy for your questions. So come back and check again. I'll be doing a presentation on closing costs, and we'll help you understand that as well. Have a great day.